It's a breakout. Yeah, it's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number, because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. I would think if the dollar should be bouncing pretty hard right now, it's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at, because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver. And that verdict is already in. Gold was $20.67, and then they took everybody's gold and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35, that started to break the back of deflation. It was an inflationary event. And there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late great Richard Russell: inflate or die. I mean, in this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call. Then the entire system comes down, and basically currencies become literally worthless, because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, I mean, they're all bankrupt. They're all upside down and insolvent. Short squeezes will end in a failure to deliver, because what happens is when you tell someone they can't have something, they want it even more. That's human nature. And I mean, we're at the point now, the sharks are beginning to smell blood in the water, that there's not enough platinum, there's not enough silver, there's not enough gold to meet the deliveries. And if any of these contracts fail to deliver, they'll all fail to deliver within 72 hours. It'll create more demand. And along with creating demand, not just paper demand, you're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time the last day, final notice comes, there's more contracts outstanding. And in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery. And that's the Achilles heel to the fractional reserve system. I mean, there's no question. I mean, even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery, because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, it breaks confidence. And the reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. I mean, we have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress the price of gold and they'd whack it. I mean, you remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and they'd whack it, 1, 2, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver.
It's a breakout. There's no other way to say it. When you look at silver here, I don't think it stops at $30 or $40. I think we're going to $50 at minimum. And when we test that old high, I don't see $50 holding. It'll blow through that like wet tissue. Then where it goes next is anyone's guess, because silver has a way of doing in weeks what gold takes years to do. Gold itself? There are no technical numbers anymore. We're in all-time high territory. When you're at the top of the mountain, there's no chart line to lean on. The next battle will be psychological, not technical. The market will test the willpower of governments, central banks, and the powers that be who have spent decades trying to keep the gold canary locked in the coal mine. But here's the way I see it. This breakout isn't just a line on a chart. It's not just traders chasing momentum. It's a global vote of no confidence in paper. That's what it is. Gold and silver are not voting for themselves. They're voting against fiat. And if you don't believe me, just look at the dollar. At a time when the dollar index, the DXY, should be bouncing hard, given all the safe haven narratives, given rate differentials, given geopolitical uncertainty, it's not. What won't go up must go down, and the dollar's heading for another leg lower. Now, people get too hung up on the DXY, but let's be clear. That's just the dollar measured against other paper promises like the euro and the yen. It's like asking who's the healthiest horse in the glue factory. The true measure is the dollar versus real money, versus gold and silver. And on that score, the verdict is already in. Gold has broken out, silver is surging, paper is being voted down by the free market, and you should pay attention to that. Let me remind you of some history. Back in 1933, gold was officially $20.67 per ounce. The government confiscated it, then revalued it at $35. That was a deliberate inflationary event. It broke the back of deflation. It reflated the system. And what's everyone whispering about today? A global gold revaluation. That should tell you something. When they start talking about changing the official price of gold, it's not about gold. It's about reflating a debt-suffocated system that cannot survive deflation. Richard Russell, one of the greatest market writers of all time, had it boiled down to 3 words: inflate or die. That's the whole ballgame. In this credit system, deflation is death. Why? Because everything is built on leverage. Everything is held on margin. When asset prices deflate, collateral shrinks. That triggers margin calls. That forces liquidation. The whole system comes down like dominoes. That's why central banks will always choose inflation. Always. Deflation is checkmate. Inflation, they can still play the game. Think about the nature of currencies. They're not backed by anything but the full faith and credit of the issuers. Well, what's the faith worth when every major sovereign is insolvent? The US is upside down. The Eurozone is upside down. Japan? A debt to GDP ratio over 250%. These are walking bankruptcies. So the currencies are only as good as the promises of bankrupt issuers. That's why the breakout in gold and silver matters. It's the market saying, we don't trust paper. We want real now. Let's talk about short squeezes and delivery. You see, the Achilles heel of this whole setup is the fractional reserve nature of the metals markets. Even the insiders will admit it. The COMEX and LBMA operate on a fractional system. Maybe 5% to 10% of the metal is actually there for delivery. The rest is paper promises. That works fine, until too many people ask for delivery at the same time. Then the whole illusion collapses, and we're getting closer to that point. Here's what's changed in the last few years. In the past, if you had 5,000 contracts standing for delivery on first notice day, by the time final delivery day came, half of them would have rolled off. Traders would cash settle or close their positions. But now, over the last 2 or 3 years, it's reversed. You start with 5,000 contracts on first notice day, and by final day, you might have 6,000 or 7,000, sometimes double or triple. That's new money coming in, not to speculate, but to stand for delivery. People want the bars. That's the Achilles heel.
You'd be surprised, Danny. A lot of hedge funds and family offices, they're knowledgeable. Not all of them, but a lot of them have been buying the physical metal.
I see.
Now, that said, I can say that for the last 9 months, even close to a year, the demand for physical metal out of North America has collapsed. But yet the price of gold, if you asked me 5 years ago or 10 years ago, is there any way gold could run from 2,700 to 3,500 and North America be a net seller? I would have said no way, because, it would stir up the greed factor. But what you're seeing is liquidations out of North America and whatever. I've gotten more sell orders in the last 9 months than I had cumulatively in the last 15 years. And I asked people, why are you selling? And I've only had maybe a couple, 3 people tell me, well, I'm going to take a profit. And I asked them, well, where are you going to put the money in a system that's going to mathematically collapse to keep it protected? And they're like, oh, well, when gold drops or silver drops, I'll go back in and I'll rebuy it. Well, go with that, because when there's a failure to deliver, there won't be anything to be had. And if you're not on the bus, you're off the bus and you can't get back on the bus. But the vast majority of people that I've asked have all said, I need the money. I need it to live on. So it tells me that the money on the streets in North America is evaporating or evaporated. Think about silver. Think about all the uses that silver has: medicinal, industrial, technological, monetary. There's so many uses for silver, and it is, in my opinion, silver is the most underpriced asset on the planet. The reality is gold is the measuring stick. We got fooled. The world got fooled for 50 years that the measuring stick was the dollar. Everything was measured against the dollar. How many dollars? The reality is dollars themselves are measured against the ultimate measuring stick, which is gold. Yeah, and the reason I say silver is the most undervalued asset on the planet, for how many hundreds of years, and even in the U.S. Constitution, the ratio is 15 or 16 to 1. You could go back 1,000. Well, first off, silver comes out of the ground just under 10 to 1 to gold. So there's roughly 10 ounces of gold pulled out of the earth for every 1 ounce of gold.
1 ounce of silver.
That's God's ratio, right? 10 ounces of silver for every 1 ounce of gold. Now, for hundreds of years, the price ratio was 16 to 1. And the reason being, back 100, 200, 300, 500 years ago, in order to transport money, you had to transport gold or silver. But if you transported silver, you had to transport 10 times the amount of silver to get the same capital. So man discounted the silver price to 15, 16 to 1 to account for, the extra carts or carriages or whatever that you needed to transport silver. So that 15-16 ratio, 15 to 1, 16 to 1, went for hundreds of years. And in today's world, now we're back down to 85 to 1. We were as high as 120 to 1. 120 ounces of silver, that's undervalued by 12-fold. And where we are now, it's undervalued by 6 or 7-fold. Well, long term, it will move up because it's a function of how much gold can be supplied versus how many dollars are created.
So let's move past the breakout itself and look at what it really means. Because a breakout in gold and silver isn't just about price charts and technical patterns. It's about confidence, or more accurately, the loss of it. When paper markets no longer reflect reality, when suppression schemes fail, when demand overwhelms supply, the market votes. And right now, the market is voting no confidence in paper currencies, in government bonds, and frankly, in the entire promise-based system. Think about the position we're in. The US government has to borrow over $2 trillion every single year just to cover expenses. That's before we even talk about rolling over existing debt. Interest expense alone is pushing toward $2 trillion annually. At some point, it will be the largest line item in the budget, bigger than defense, bigger than Social Security, bigger than Medicare. And here's the kicker. That's with today's rates. If rates stayed elevated, the Treasury would choke to death. If rates drop, the dollar implodes. It's checkmate either way. This is why the idea of gold revaluation keeps surfacing. In 1933, they took everyone's gold and revalued it from $20.67 to $35 an ounce. That was a deliberate inflationary move to fight deflation. It worked because gold is the anchor. Raise the official price of gold and suddenly your reserves look larger, your balance sheet looks less insolvent, and your ability to inflate without immediate collapse expands. That's why you keep hearing chatter about a worldwide revaluation today. It's the same playbook, only the numbers will be orders of magnitude higher. And remember, when they do it, they're not doing it for you. They're doing it to save the system. Richard Russell's line, "Inflate or die," is truer now than ever. Deflation in a system built entirely on margin is a death sentence. Assets fall, collateral shrinks, margin calls trigger, liquidations cascade, and the entire edifice comes down. That's why the central banks have no choice. They must inflate. They must suppress yields. They must debase, because the alternative is extinction. But inflation destroys confidence too. And that's where gold and silver come in. They're the report cards. You can lie with CPI numbers. You can fudge GDP. You can seasonally adjust unemployment. But you cannot hide what gold and silver are telling you. If they're breaking out to new highs, it's the world screaming, "We don't buy your numbers anymore." Now let's talk about delivery dynamics again, because this is the Achilles heel. In a fractional reserve system, the assumption is always that not everyone will ask for their money at once. It's the same with banks. You deposit $100, the bank keeps $10 and lends out $90, hoping you don't all show up tomorrow demanding cash. COMEX and LBMA operate the same way with metal. Only 5 to 10% of the contracts can actually be delivered in real bars. The rest is paper. For decades, the game worked because most traders never stood for delivery. They rolled contracts or settled in cash. But that's changing. Over the past few years, more and more players, not speculators but serious money, are buying contracts specifically to take delivery. And once they do, they're not returning those bars. They're leaving the system. That drains the pool of available supply. And the psychology kicks in. Once people suspect delivery might fail, they demand it even more. It becomes a run on the vault. And here's the thing. All it takes is one high-profile failure to deliver. One. When that happens, the perception flips overnight. Paper contracts go from being treated as equivalent to metal to being recognized as worthless promises. That collapse in confidence would ripple globally. You can already see the sharks circling. Platinum markets, silver markets, even gold. Deliveries are getting tighter. Industrial users, sovereign buyers, wealthy investors, they all want the real thing. Why? Because they see that the cupboard is bare. The smell of blood is in the water. I'll put it this way. If one contract fails, they all fail within 72 hours. That's how fragile this is. That's why I keep saying, if you don't hold it, you don't own it. If your claim to metal is a piece of paper or a digital entry, it's not yours. When the system is stressed, those claims will be broken. Now let's zoom out to geopolitics, because this isn't happening in a vacuum. The BRICS nations led by China and Russia have been hoarding gold for years. Central banks set a record in 2022, then almost matched it in 2023, and they're still buying. Why? Because they know the dollar's days as uncontested reserve currency are numbered. They don't need to launch a new currency tomorrow. They just need to quietly back their trade with gold, accumulate reserves, and reduce exposure to treasuries. And that's exactly what they're doing. Look at the flows. The East is buying, the West is selling, treasuries are being dumped, gold is being bought. That's the tectonic shift under our feet. Meanwhile, the US and its allies are weaponizing the dollar, freezing Russian reserves, sanctioning nations, threatening exclusion from SWIFT. These are signals to the rest of the world. Your dollar assets are not safe, and the rest of the world is listening. If your reserves can be frozen with a keystroke, they're not reserves. They're hostages. Gold cannot be frozen, censored, or defaulted on. That's why central banks are choosing it. Now here's a little gallows humor. Someone tweeted, "The US dollar is the only product where the more they print, the more they claim it's scarce." That's the kind of upside-down logic we live in, and that's why gold and silver are exploding. Let's bring it back to silver for a minute. Silver is unique because it's both money and an industrial metal. It gets consumed in solar panels, EVs, electronics, and medical applications. Unlike gold, a huge percentage of silver ends up unrecoverable in landfills or products. That means above-ground stockpiles are shrinking. Combine that with the monetary demand, and you have a powder keg. People ask me, "Bill, could silver really go to $100, $200 more?" My answer is yes, not because of speculation, but because of supply and demand and the collapse of confidence in paper. History tells us silver at 15 to 1 relative to gold was normal for centuries. At today's gold price, that would imply silver well north of $200. Even 20 to 1 would mean triple-digit silver. That's not crazy talk. That's reversion to historical norms. Gold itself has no ceiling here. Once you're in all-time highs, the technical resistance is gone. The only resistance is political. And as the debt spiral continues, as inflation erodes confidence, as deliveries tighten, political suppression will fail. You can already see it. They've thrown everything at gold over the years. Naked shorts, central bank sales, media campaigns. But the market is bigger than them now. Sovereigns are bigger. The East is bigger. The suppression game is unwinding. Now let's tie this back to confidence again. The U.S. Treasury market depends on confidence. Foreigners have to believe they're lending to the safest borrower in the world. That illusion only works if gold is tame. See? Gold is calm. The dollar is king. Treasuries are safe. But once gold starts screaming, that narrative collapses. And when big sovereigns start selling treasuries to buy gold, that's your sign. They're voting with their feet. Here's another way to look at it. The dollar index is like grading on a curve in a class where everyone's failing. Gold and silver are the absolute grades. They don't lie. They show you how badly the paper students are doing, no matter how you juggle the curves. And I'll close with this warning and a bit of humor to soften it. The warning is simple. The fuse is lit. Delivery pressures, sovereign flows, debt spirals, all of it is converging. When the failure to deliver hits, when the first domino falls, the system won't gradually adjust. It will break. Paper claims will be worthless. Gold and silver will gap higher, and those without physical will be left out. The humor is this. I saw a meme that said, "Don't worry, the government has a plan. They're just not sure if it's plan A, B, C, or Armageddon." That about sums it up. Their plan is to survive another day. Your plan should be to survive the collapse of their plan. So yes, it's a breakout. But more than that, it's a signal. The system is creaking. Confidence is eroding. The sharks smell blood. And when that delivery failure finally happens, it will be too late to prepare. If you're not on the bus now, you won't be on it at all.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.